Welcome to This Explainer. Today, we're taking a really analytical look at the mechanics of banking disruption. We're going to step back from the daily headlines for a minute and instead connect modern technology with a massive 5,000-year historical cycle of trust, debt, and control. Because, as you'll see, by understanding the ancient architecture of finance, we can actually predict almost exactly where the digital disruption of today is heading. So let's just dive right in with a question that, honestly, sounds a little crazy at first. What does a 5,000-year-old Babylonian temple have to do with modern blockchain? It sounds like a total stretch, I know, but the world's first bank receipts are actually a direct technological ancestor to today's tokenized deposits. The human problems we're trying to solve are exactly the same, literally only the technology has changed. To map this all out, we're going to trace 5 key themes today: the architecture of trust, fractional reserves, sovereign versus private money, open API empires, and finally, the future of core banking. Starting off with Section 1, the architecture of trust, going from clay to code. It's fascinating. Banking actually predates money itself. Think about it. 5,000 years ago, if you were a merchant traveling hundreds of miles with a bunch of physical silver, you faced massive friction, namely bandits. So merchants deposited their wealth in the only safe places around, temples like Marduk in Babylon. The priests there issued clay tablets with cuneiform writing as proof of your deposit. This was a secure, decentralized architecture of trust. Fast forward today, and moving capital across fragmented digital borders still creates enormous friction and delays. Modern blockchain ledgers and tokenized deposits are simply the digital evolution of those immutable clay tablets, a secure, verifiable record of value held. Now, the absolutely crucial point here is how modern financial institutions actually view this technology. As Tim Mills over at Regions Bank points out, blockchain isn't necessarily this wild, disruptive overhaul that's going to destroy banking. Instead, it's more of a targeted enhancement tool meant to solve specific friction points, like those delays in multiple intermediaries and cross-border payments. Just as the temple's clay tablets sped up ancient trade by replacing heavy silver, modern smart contracts and tokenized deposits are poised to automate and accelerate today's commercial workflows. Moving right along to Section 2, fractional reserves and monetary strain, essentially the engine of growth. This perfectly illustrates the origin of modern credit. Ancient priests noticed something huge. Depositors didn't all come back for their wealth at the exact same time. The wealth just sat there, idle, so they started lending it out. They were issuing clay tablets for silver they didn't physically have on hand, as long as they kept a fraction of it in reserve. Now, this mathematical truth was rediscovered by goldsmiths in the 1600s who issued paper promissory notes, which, by the way, is a system that directly echoes the mechanics of the digital wallets on our phones today. Ultimately, this forms the bedrock of our modern central banking system. It's an engine that allows economies to grow way faster than the physical money supply. But as you might guess, private financial power grows incredibly fast when you can just create credit. By 1750 BC, the Temple of Marduk became so ridiculously wealthy it actually rivaled the state. In response, King Hammurabi instituted the world's very first banking regulations. He capped interest on silver loans at exactly 20% and mandated minimum reserves. It was the first time a government had to step in simply because a private financial institution had accumulated way too much systemic influence. And that brings us right to our modern dilemma. Just like those ancient kings struggled to manage the explosive growth of temple credit, today's central banks are finding that their traditional monetary policy is faltering. We're dealing with historically high debt levels and a rapid digitization of finance. Today, capital markets, shadow banking, and decentralized finance, DeFi, operate at absolute light speed. They're actively challenging the traditional trust role that central banks have held for centuries. Because of all this, the transmission of standard interest rate policies is being severely diluted. The system has just become so complex that the old levers simply don't pull quite like they used to. Which leads us perfectly into Section 3, sovereign power versus private money, the ultimate battle for control. So, Rome was arguably the first power to really weaponize banking. They figured out that controlling money literally meant controlling territory. By flooding conquered provinces with loans denominated in Roman fiat currency, they created total economic dependency. Think about it. You couldn't rebel against Rome without destroying your own economy. Today, we're seeing a digital echo of this exact same battle for control. As private digital currencies and stablecoins threaten to completely circumvent state money, sovereign governments are actively responding by developing central bank digital currencies, or CBDCs. It is quite simply the state asserting its authority over the digital ledger. When we look at the most likely scenarios today, we're seeing a very cautious rollout. Central banks will probably deploy wholesale CBDCs first, with strict holding limits on retail versions. Why? To prevent massive, destabilizing shifts away from traditional bank deposits. What we're heading toward isn't a total state takeover, but rather a highly fragmented, competitive monetary landscape. We're going to see CBDCs awkwardly coexisting alongside regulated private stablecoins and traditional bank deposits. All right, Section 4, Open Banking and API Empires, focusing on the distribution layer. Let's jump to the Renaissance and the colonial era. Entities like the Dutch East India Company took financial control to an entirely new level. They didn't just store wealth, they essentially became sovereign entities themselves. They issued their own currency, collected taxes, and operated massive, closed economic loops across continents. Literally every transaction generated a profit for the same institution. They completely controlled both the financial product and the total distribution of that product. Fast forward to today, and we're seeing something that's totally disrupting that closed-loop model. Application Programming Interfaces, or APIs, are acting as this incredibly powerful pivot between financial products and distribution. For the very first time, banks can actually decouple the creation of a financial service, like a loan or a payment rail, from the front-end customer experience. Because of this massive decoupling, the Euro Banking Association points out that banks are finally breaking out of their traditional closed loops. Now they have to choose one of four distinct strategic roles in the digital value chain. They can be an integrator, distributing their own products. They could be a producer, creating white label services for fintechs, a distributor, selling third-party products, or a platform, acting purely as an intermediary. If you map this out on a grid, you have product creation on the bottom axis and distribution on the vertical axis. Every single financial institution looking at embedded finance has to figure out exactly where they sit on this grid. Because if a bank doesn't adapt to open APIs, they risk being pushed entirely into the background as a low-margin utility, while sleek tech companies swoop in and capture all that high-margin customer distribution. And that brings us to Section 5, the future of core banking, our synthesis for 2040. Synthesizing this 5,000-year arc, the immediate roadmap is actually surprisingly pragmatic. Based on insights from industry leaders, the next 3 to 5 years won't be about chaotic disruption, but targeted evolution. First up, expanding blockchain use cases to fix cross-border payments. Next, banks are going to form secure, permissioned networks among themselves. And finally, we'll see the full scaling of tokenized deposits. The industry is systematically upgrading the plumbing of global finance, but they're doing it without tearing down the house. But looking a bit further out, let's say 10 to 15 years, banking is likely going to shift to operate largely as an invisible, automated background platform. Think about it. Just as you don't think about the electrical grid when you plug in a lamp, you won't even think about the bank when you transact. We're going to see a seamless integration where banks act as the trusted infrastructure layer, managing the complex coexistence of private tech innovation and sovereign digital currencies. It's a complete pivot from owning the direct customer product to integrating perfectly into a wider digital ecosystem. We've seen ancient temples become states, emperors conquer through fiat debt, and massive corporations create closed economic loops. The fundamental human drive to manage trust and control capital hasn't changed a bit in 5,000 years. So as we step into this new digital era of open APIs, tokenized deposits, and fragmented digital currencies, I'll leave you with this one thought. When literally every company can be a fintech company, who will truly control the financial empires of tomorrow? Thank you for watching this explainer, and keep questioning the systems that run our world.